Recessions. The word alone makes investors nervous. Markets crash, headlines scream, portfolios shrink. But here's the question. When the economy tanks, which investment comes out on top? Real estate or stocks? Today we're going deep. We'll look at what happened in 2008 during the Great Financial Crisis and what happened in 2020 during the COVID crash. We'll compare how real estate and stocks performed, how long they took to recover, and which one might protect your wealth better the next time a recession hits. By the end, you'll know how each asset class reacts in a downturn and which might be the better choice for your investing strategy. Setting the stage. Before we jump into the history, let's set the stage. Stocks and real estate are both considered growth assets. Both can create wealth over time, but they behave very differently in a recession. Stocks are liquid. Prices adjust instantly as investors react to news. That means they can drop fast, but also recover fast. Real estate is slower to react. Prices are based on transactions, not constant trading. This means declines often lag behind the recession itself. Both can lose value, both can recover, but the path they take and the investor experience can be very different. Let's go back to 2008, the Great Financial Crisis. Stocks first. In October 2007, the S&P 500 peaked. By March 2009, it had fallen 57%, more than half of the market's value gone in about 17 months. Investors who sold in panic locked in huge losses. But those who held on? From the bottom in March 2009, it took about 4 years to get back to the previous high. Now real estate. The Case-Shiller U.S. National Home Price Index peaked in 2006. By early 2012, prices were down about 27% nationally. In some markets, it was much worse. Las Vegas, down over 60%. Phoenix, down nearly 55%. Florida, similar story. Recovery took a long time. Many markets didn't regain their pre-crash prices until 2016 or later. But here's the twist. If you were a landlord during that time, rents didn't collapse the way home values did. In fact, in many areas, rents stayed steady or even went up because fewer people could buy homes. So in 2008, stocks dropped faster and recovered faster. Real estate dropped slower, but the pain lasted longer. Cash flow properties still produced income, but new financing was harder to get. Now let's fast forward to 2020, the COVID-19 pandemic. In February 2020, the S&P 500 hit an all-time high. By March, it had fallen about 34% in just over a month, the fastest bear market in history, but the recovery also the fastest. By August 2020, stocks had already hit new highs. It took less than 6 months to fully recover. Now real estate. The housing market paused for a couple months in spring 2020. Sales slowed, but prices? They didn't crash. In fact, after a short slowdown, prices started rising rapidly. Low interest rates, remote work, and housing shortages drove prices to record highs through 2021 and 2022. So in 2020, stocks fell hard and fast, then rebounded quickly. Real estate barely dipped in most markets, and then skyrocketed. This recession was unique because it wasn't driven by real estate or banking, and stimulus money plus ultra-low rates pumped both markets back up quickly. Why stocks fall faster? Stocks are priced every second the market is open. That means investor fear, uncertainty, and panic show up instantly in prices. Liquidity is a double-edged sword. You can sell quickly, but so can everyone else. And when everyone runs for the exit, prices fall fast. In 2008 and 2020, stocks reacted immediately to bad news. That's why the drops were sharp, and why the recoveries could also be sharp when sentiment turned positive. Why real estate moves slower? Real estate transactions take time. Listings, showings, inspections, closings. It's a long process. This means prices don't collapse overnight. It can take months for the market to reflect reality. In 2008, the slowdown in sales started before the crash in prices. By the time values were down 10%, the broader economy was already deep in recession. In 2020, the slowdown in activity didn't translate to lower prices. Because supply was already tight and demand returned quickly once people realized interest rates had dropped. Here's one of the biggest differences between the two assets in a recession. Stocks rely heavily on capital gains for most investors. When prices drop, your portfolio value drops, and your dividend income may also be cut. Real estate investors can still collect rent even if home values fall. As long as tenants pay and expenses are covered, your income stream continues. That's why some investors prefer real estate in a downturn. It can provide stability even if asset values temporarily drop. Another factor, how it feels to hold each investment during a recession. Now, with stocks, you see your portfolio value drop every day. It's on your phone, in the news, in your brokerage account. With real estate, you might not check Zillow every day. If your tenants are paying and your mortgage is covered, the paper loss is less visible. This difference in visibility can make it psychologically easier to hold on to real estate in a downturn, even if the actual loss in value is similar. So, which wins in a recession? In 2008, stocks fell harder and recovered faster. Real estate fell slower but took years to fully recover. Cash flow from rentals held up better than stock dividends. In 2020, stocks dropped sharply but rebounded in months. Real estate barely dropped and then surged. The answer depends on your goals. If you want quick recovery potential, stocks have historically bounced back faster. If you want income stability, real estate can provide it even during downturns. How to prepare your portfolio. The truth is, you don't have to choose only one. A mix of both can give you balance. Stocks for liquidity and growth, real estate for income and stability. In a recession, that balance can help you weather the storm better than going all in on one asset class. Recessions are a test. They test your investments and they test your patience. Both stocks and real estate have strengths and weaknesses when the economy turns. The key is knowing which fits your goals, your timeline, and your risk tolerance. If you plan ahead, diversify, and avoid panic, you can come out of a recession stronger than you went in. If you found this breakdown helpful, hit like and subscribe for more investing deep dives. And let me know in the comments, in the next recession, will you bet on stocks or real estate?